Picture this. You're scrolling through your phone and you see a headline that says, "Markets crash, investors lose billions." And you're just sitting there thinking, cool, what does that even mean? Or maybe your parents are watching the news and the guy on screen is sweating through his suit talking about bearish trends and yield curves, and your brain just shuts off completely. Here's the thing. The stock market isn't some secret club for rich guys in suits. It's actually one of the most important financial tools on the planet, and nobody teaches it in school. So today, we're fixing that. Every major stock market term explained in plain English, no textbooks, no boring charts, just the stuff you actually need to know.
The stock market. Let's start at the beginning. What actually is the stock market? Think of it like a giant marketplace, like Amazon, but instead of buying shoes or headphones, people are buying and selling tiny pieces of companies. Apple, Nike, Tesla, your favorite gaming brand, all of them. This marketplace has a physical location, but most of it runs digitally, and billions of dollars move through it every single day. The stock market is basically the world's biggest group project, where everyone's betting on which companies are going to win. Stocks. A stock is a tiny slice of ownership in a company. When you buy one Apple stock, you literally own a small piece of Apple. You're not running the meetings or picking the iPhone colors, but you are a part owner. Companies sell these slices, called shares, to raise money to grow their business. And when the company does well, your slice becomes more valuable. When it tanks, so does your slice. Simple as that.
Share price. The share price is just what one single stock costs to buy right now. Apple might be $200 a share today. Tomorrow it could be $195 or $210. That number changes constantly based on what people think the company is worth. And here's the wild part. The price isn't decided by the company. It's decided by millions of buyers and sellers agreeing on what they're willing to pay. It's basically a massive, never-ending auction running every weekday. Bull market versus bear market. These two are everywhere, and nobody explains them properly. A bull market is when stock prices are rising and the economy feels good. Everyone's confident, people are spending, companies are growing, and investors are making money. Think of a bull charging forward, aggressive, powerful, moving up. A bear market is the opposite. Prices are falling, fear is in the air, and people are pulling their money out. Think of a bear hibernating, going quiet, pulling back, waiting it out. Typically, if the market drops 20% or more from its recent peak, it's officially a bear market. And yes, both happen. Always have, always will. Portfolio. Your portfolio is just the collection of all the stocks and investments you own. Think of it like your Spotify playlist, except instead of songs, it's stocks. One person's portfolio might have Tesla, Nike, and some government bonds. Another person's might be entirely Apple. The combination you choose says a lot about your strategy and how much risk you're willing to take. Diversification. This is the golden rule of investing, and it's basically just the fancy word for don't put all your eggs in one basket. If you put every dollar you have into one single gaming company, and that company gets caught up in a scandal, you're wiped out. But if your money is spread across tech, food, healthcare, and real estate, one bad company doesn't destroy you. Diversification is your financial seatbelt. It won't make you rich overnight, but it'll save you when things go wrong. Index. An index is a way of tracking how a group of stocks is performing together. The most famous one is the S&P 500, which tracks the 500 biggest companies in the US. Apple, Google, Amazon, all of them in one number. When you hear the market went up today, they usually mean an index went up. It's like a scoreboard for the entire economy. Instead of watching 500 individual scores, you just look at one number. ETF, Exchange Traded Fund. An ETF is basically a pre-built portfolio you can buy as one single stock.
Instead of buying Apple, then Nike, then Tesla one by one, an ETF bundles them all together and you buy the whole bundle at once. There are ETFs for tech companies, for green energy, for gaming, you name it. They're popular because they're cheap, easy, and automatically diversified. For beginners, ETFs are one of the smartest starting points.
Dividend. Some companies don't just make their stock more valuable, they also send you cash just for owning their stock. That cash payment is called a dividend. It's like your investment is a rental property and the company is your tenant, paying you monthly rent just because you own it. Not every company pays dividends. Apple does, Nike does, but a lot of growth companies reinvest their profits instead of paying them out. Dividends are a big deal for long-term investors who want steady income. Broker. A broker is the middleman between you and the stock market. Back in the day, you'd call an actual human broker on the phone and tell them what to buy. Now, apps like Robinhood, Fidelity, or Charles Schwab do the same thing digitally. They take your order, execute the trade, and hold your shares. Most of them are free to use now, which means anyone with a phone can start investing. The barrier used to be high. Now it's basically just your age and having a few dollars to start. Market cap. Market cap, short for market capitalization, is the total dollar value of a company's shares combined. You calculate it by multiplying the share price by the total number of shares. Apple is worth over $3 trillion in market cap. That makes it one of the biggest companies in human history. Market cap tells you the actual size of a company, not just its price per share. A $5 stock can belong to a massive company if it has billions of shares. Don't judge a company by its price tag alone. Volatility. Volatility is how wildly a stock's price moves up and down. A stock that jumps 10% one day and drops 8% the next is highly volatile. A stock that barely moves is low volatility. High volatility means high risk, but also the possibility of high reward. Low volatility is steady and boring, but boring in investing often means safe. Crypto, for example, is extremely volatile. Government bonds barely moves. Knowing this helps you decide what you can stomach watching. IPO, Initial Public Offering. An IPO is the moment a private company decides to go public and sell shares to regular people for the first time. Before an IPO, only insiders, founders, employees, private investors can own a piece of the company. The IPO is the grand opening. Companies like Snapchat, Airbnb, and Duolingo all had IPOs. It's usually a big deal, covered all over the news, and the share price on day one can be unpredictable. Some IPOs explode, some immediately sink. It's exciting, but risky. Earnings report. Every 3 months, 4 times a year, publicly traded companies have to report how much money they made. This is called an earnings report. The market reacts hard to these. If a company made more money than people expected, the stock jumps. If they made less, the stock drops. Even if a company made $1 billion in profit, if people expected $2 billion, it's seen as a failure. Earnings season, when all companies report at once, is basically the Olympics of the stock market. Recession versus market crash. These are related, but not the same. A market crash is when stock prices drop dramatically in a very short period, sometimes days. The 2020 COVID crash wiped 34% off the market in just 5 weeks. A recession is a broader economic slowdown. The whole economy shrinks, jobs get cut, and spending drops. A crash can trigger a recession, and a recession can cause a crash, but one doesn't always lead to the other. Both are scary, both are survivable, and both have happened dozens of times throughout history. The bottom line. Here's what all of this comes down to. The stock market is not a casino. It's not just for Wall Street guys or people with money to burn. It's a system, and like any system, once you understand the rules, you can use it to your advantage. The terms that used to sound like a foreign language, you just learned them all. Bull markets, ETFs, dividends, IPOs, that's your vocabulary now. Most people wait until they're 35 to start paying attention to this stuff. You're already ahead, and in investing, being early is basically the entire game.